Investing is simple. You use your money to make more money. Imagine your money working for you, even while you sleep. It's about building wealth over time, not getting rich quickly. Investing helps you achieve your financial goals. Want to buy a house? Retire early? Investing can help you get there. By investing, you beat inflation. Inflation makes things cost more over time. Investments help your money grow faster. Investing isn't just for the wealthy. You can start small and grow your investments over time. Remember, the best time to start investing was yesterday. The second best time is today. Before you jump into investing, let's lay some groundwork. First, set clear financial goals. Do you want to buy a home? Retire early? Knowing you're investing keeps you motivated. Next, build a strong financial foundation. Pay off high-interest debts like credit cards. This frees up more money to invest. An emergency fund is crucial. Aim for 3 to 6 months of living expenses in a separate account. This protects you from unexpected events. Once you're debt-free and have an emergency fund, you can start investing more aggressively. Remember, investing is a marathon, not a sprint. Patience and consistency are key. Risk tolerance is how much risk you're comfortable taking with your investments. Are you okay with some ups and downs in your portfolio? Or do you prefer slow and steady growth? Younger investors often have a higher risk tolerance. They have more time to recover from losses. Older investors might prefer lower risk investments to protect their savings. There's no right or wrong answer. It depends on your individual circumstances and goals. Understanding your risk tolerance helps you choose the right investments. It prevents you from making emotional decisions based on market fluctuations. Remember, investing is about making informed choices that align with your goals and risk appetite. Let's explore the different roads on your investment journey. We'll cover the basics from stocks and bonds to real estate and more. Each avenue has its own characteristics, risks, and potential rewards. Diversification is key to a balanced portfolio. Don't put all your eggs in one basket. By spreading your investments, you reduce the impact of any single investment performing poorly. Remember, investing is not about timing the market, but about the earlier you start, the more time your investments have to grow. So let's dive into each investment type and see which one suits your needs and risk appetite. Section 5. Diving into stocks and bonds. In this section, we will explore the fundamental differences between stocks and bonds, two of the most common investment vehicles available to investors. Stocks represent ownership in a company. When you purchase a stock, you are essentially buying a small piece of that company, becoming a shareholder. When you buy a stock, you're buying a small piece of that company. This ownership entitles you to a portion of the company's profits, which may be paid out as dividends. Stock prices can fluctuate greatly, making them a higher risk investment. The value of your investment can rise and fall dramatically in response to market conditions, company performance, and economic factors. However, they also have the potential for higher returns over the long term. Historically, stocks have outperformed other types of investments, making them attractive for those willing to take on more risk. Bonds, on the other hand, are like loans you give to a company or government. When you purchase a bond, you are lending money to the issuer in exchange for periodic interest payments. They offer fixed interest payments over a specific period, making them generally less risky than stocks. The interest payments are typically made at regular intervals, providing a predictable income stream. Bonds provide a steady stream of income, making them suitable for more conservative investors. They are often used to preserve capital and generate income, especially in retirement portfolios. Investing in individual stocks and bonds requires research and understanding of market dynamics. It's important to analyze the financial health of the companies or governments issuing these securities. Consider starting with index funds or ETFs, which offer instant diversification. These funds pool money from many investors to buy a broad range of stocks or bonds, reducing risk. Before investing in any asset class, thoroughly research or consult a financial advisor. Understanding your risk tolerance and investment goals is crucial to making informed decisions. Remember, knowledge is power, and a well-informed investor is more likely to achieve their financial objectives. Section 6. The power of index funds and ETFs. In today's financial landscape, understanding these investment vehicles can be a game changer for your portfolio. Index funds and ETFs are like baskets of stocks or bonds. They pool together a variety of assets, offering you a slice of the market without the need to buy each stock individually. They track a specific market index, such as the S&P 500. This means their performance mirrors that of the index they follow, providing a straightforward way to invest in the market. Index funds offer instant diversification and are managed passively, meaning lower fees for you. Passive management involves less buying and selling, which reduces costs and can lead to better long-term returns. ETFs trade like stocks on exchanges, providing flexibility. You can buy and sell them throughout the trading day, just like individual stocks, which offers more control over your investment timing. They are a cost-effective way to invest in a diversified portfolio. With lower expense ratios compared to mutual funds, they help you keep more of your returns. Both index funds and ETFs are excellent options for beginners due to their simplicity and diversification benefits. They allow new investors to gain exposure to a broad market without needing extensive knowledge or experience. Remember, diversification is your best friend when it comes to mitigating risk. By spreading your investments across various assets, you reduce the impact of any single asset's poor performance on your overall portfolio. Index funds and ETFs provide a hassle-free way to achieve diversification without needing to pick individual stocks or bonds. This hands-off approach can save you time and effort, making it easier to stay invested for the long term. Section 7. Real estate, a tangible investment. Real estate involves buying, owning, and selling physical properties. It can provide rental income and potential appreciation in value over time. Real estate is considered a more tangible investment compared to stocks or bonds. However, real estate requires significant capital and comes with responsibilities like property maintenance. It's crucial to conduct thorough research and due diligence before investing in real estate. Consider starting with REITs, real estate investment trusts, if you're not ready to own physical property. REITs allow you to invest in real estate through the stock market, providing liquidity and diversification. Section 8. Charting your investment journey. Now that you understand different investment options, let's chart your course. Start by setting up a brokerage account. This is where you'll buy and sell investments. Research different brokerage platforms and choose one that aligns with your needs and budget. Many online platforms offer commission-free trading, making investing more accessible. Once you have a brokerage account, you can start investing in your chosen asset classes. Remember, start small and gradually increase your investments as you gain confidence and knowledge. Section 9. Creating a budget for investing. Investing doesn't require a fortune. Start with what you can afford to invest consistently. Create a budget to track your income and expenses. Identify areas where you can cut back on spending and redirect that money towards investing. Automate your investments by setting up regular transfers from your checking account to your brokerage account. This pay-yourself-first approach ensures that you're investing consistently, regardless of market fluctuations. Remember, even small amounts invested consistently over time can grow significantly due to the power of compounding. Every dollar you invest is a step towards achieving your financial goals. Section 10. Starting your investment journey. Congratulations on taking the first step towards securing your financial future. Starting your investment journey is an exciting milestone. Remember, investing is a long-term game. Don't be discouraged by short-term market fluctuations. Stay focused on your goals, diversify your investments, and continue learning. There are countless resources available online and offline to expand your investment knowledge. Consider consulting with a financial advisor if needed. They can provide personalized guidance based on your individual circumstances. Remember, the most important thing is to start investing today. The sooner you begin, the more time your money has to grow. Section 11. The long game of investing. Investing is not about getting rich quick. It's a disciplined approach that requires patience and a long-term perspective. It's about building wealth gradually over time. Be patient and stay the course, even when the market experiences downturns. Remember, the market will have its ups and downs, but over the long run, it tends to trend upwards. Market corrections are a natural part of the economic cycle. They can be unsettling, but they are also necessary for a healthy market. View market downturns as opportunities to buy investments at discounted prices. This is often when the best bargains can be found. Stay informed about market trends and economic indicators, but don't let short-term noise distract you from your long-term goals. It's important to keep a level head and not make impulsive decisions based on daily market movements. Investing is a journey, not a destination. It's about setting goals, making a plan, and sticking to it, even when the going gets tough. Continue learning, adapting, and refining your investment strategy as you gain experience and knowledge. The more you know, the better equipped you'll be to make informed decisions. The most important thing is to stay invested and let the power of compounding work its magic. Over time, your investments can grow exponentially, turning small contributions into significant wealth. Please do well to like, subscribe, share, and leave a comment.